This year, 38 simple trades were made over Nvidia with a total profit of $11,117. Average trade duration is a little over 6 days, and average P&L is $293, and with a rain rate of 97%. Hey, welcome to 1 Hour Options channel. Hope you're doing well. In this video, I'll show you how to make passive income via options trading, which I call it pivot for beginners and or any size account. The strategy I use for this video is for Nvidia, and where I show you consistently making money by trading as little as 1 hour a week. And the strategies are simple, effective, and you can go back and do the things that you enjoy the most. So this is not a financial advice. So Nvidia today is trading at 3.49 trillion market capitalization, the second largest company in the world. It closed at 142.44 cents on December 6, 2024. And you can see Nvidia in the last 25 years, it has only 4 years has a negative return. And the rest of the 21 years have positive returns, impressive of over 300%. In the last couple of years, 233% and 195% year to date for 2024. So if you would have invested $1,000 in 1999, in today on 2024, you would have made over $3 million. Guess what? 1999, you probably weren't born yet, or you don't know what Nvidia stock is. So if you would have invested $1,000 in the last 10 years since 2014, you would have made $390K. So the takeaway is Nvidia is not a trading stock. Nvidia is a long-term holding and investing stock. Time in the market is better than timing the market, so this applies to Nvidia. If buying and holding Nvidia forever, how can one generate passive income? So passive income via option trading strategies for Nvidia are designed to make passive income consistently by managing as little as 1 hour a week. So number one strategy is to make limited passive income by using cover calls. Number two, enhanced passive income, which has a lot more upside by trading call ratio spread strategy. And number three, which will generate a lot more income, which I call it triple income strategy, that includes strangle and or cash secure put plus call ratio spread. In this video, I'm only going to go over the cover call in step by step, showing you where to enter the trade, what the trade plan should be, and how we manage the trade and the risk. And lastly, the most important is where do we exit the strategy. Okay, before I show you the cover call in step by step, I want to share with you statistic and the nature of these trades and my performance, of course. I've made over 38 trades since March of 2024 to December 6, 2024. These trades include a mix of ratio call and cover call. Out of these 38 trades, only one trade I lost money. So the total P&L on these trades is $11,117. The average trade duration is a little over 6 days. Remember, this is a weekly trade options. And the average P&L is $293. The win rate is 97%. So this is a very high winning strategy. And only one trade out of 38 trades I lost money. Again, losing money is part and parcel of this process, but in the long run, we need to make passive income, which I did. And the number of cover calls out of 38 trades is 15, generating over $5,000, and the number of ratio calls is 23, generating over $6,000. So I said over 38 trades because I have an existing trade right now that is ongoing. December 13, 2024, strike price $155 cover call, and the collected $120 premium. So the weekly profit on this, I only have one trade that I lost money, and the monthly profit in May, I make the most, over $2,000, and the monthly balance, you can see the passive income keep going up. For $11,000 profit for Nvidia in my portfolio is equivalent to 6.5% up. So if you have the Nvidia, Year to date, 195% up, plus 6.5% from pivot strategy, you can generate over 200% return. Now, this is better than quarterly dividend, much better, because quarterly dividend pays you quarterly. This strategy pays you weekly and monthly. Okay, so if you made it this far to this video, please smash the like button, subscribe to get notified for the future videos. Okay, so limited income strategy cover calls. So before we go into the strategy itself, I want to make sure we understand what cover call is. So I'm just going to give an AI generated answer since we're talking about Nvidia. A cover call is an options trading strategy where an investor generates income by selling or writing a call option on the stock they already own by giving someone the right to buy their shares at a set price, which we call the strike price, within a specific time frame while still retaining ownership of the stock, which is an expiration date. It is a relatively safe strategy because the investor is covered by the shares. The only downside on this strategy is it limits the potential upside profit by obligating them to sell the stock at a strike price if the stock price rises above that. Okay, so before we look at the actual trading platform, it's always nice to take a look at where the stock is in relation to its history, right? So Nvidia today, December 6, 2024, it closed the price at 142.44. It peaked 52-week high a few days ago. It's also the all-time high for the stock at $152.89. So if we are going to trade from 142 range, we should be careful that this stock price is going to come and test that 52-week high, right? So the stock price can actually go either way, right? It can go up, it can go sideways, it can go down from here, right? But since we're doing the cover call, we only look at the upside. Now, I'm curious how many percentage points the stock price need to go test it the all-time high, 152. So it's about 7% upside. Now, if we're going to trade a week from now, December 13, 2024, if I choose as a strike price of 155, I want to choose a little bit higher than the all-time high because Nvidia will most likely come and test that 152.50 cents again. So if I choose another strike price that is higher than 152, which is 155, Nvidia has to come up almost 9% within a week. So which is, it's not impossible, but it is quite a task for Nvidia, even for Nvidia to reach. The stock has to come up 9% within a week, right? So when you do the option trading, you want to make sure you have the edge. In this case, we do have an edge, but what is our edge? Our edge is the realized move of the stock price is always lower than the expected move. So the idea is to identify what is the expected move. As long as we are trading above the expected move, then that should be our edge. Even though for the most part, the realized move is always lower than the expected move for the most part. Okay, so it's easy to find the expected move. You don't really have to do any calculations. If you're trading on the Thinkorswim platform, the expected move is shown on the expiration date that you're trading. In this case, it's almost 5.975 plus or minus value, so almost $6. So we're trading the weekly options on December 13, 2024. If today's price is 142.44 plus or minus $6 movement, that means the expected price is somewhere between 136 and 148. Since we're doing the cover calls, I'm only going to show the call side of the option chain now. So expected range is 136 and 148. Remember, the peak price is 152, so we're going to trade one strike higher than the peak price. So I choose a 155, and there are three reasons why I chose it. Number one, the probability of touching the strike price is less than 10%. So in here, 7%. And then probability of passing it, which is the probability of the strike price expiring in the money, it's less than 4%. And the premium gave me 11 cents. One the time I traded, it was 12 cents. So it actually meets my passive income criteria, what I was looking for. So I'm happy with it. So I actually went with this strike price. So before trading, you want to consider the worst case scenario, which is your trade plan, right? So Nvidia from here on out, $142 can go to the moon. So if it does, Nvidia upside, your stock appreciation can be very limited. So when entering the trade using cover call strategy, our outlook on the stock is no speculation on directional movement or moderately bullish. The level of effort is passive, which means we really don't have to manage this trade at all. We will let it either expire or roll at the touching strike price. So first step is you need to own the Nvidia stocks. Second, you will choose the weekly trades. And third, we will avoid the earning days or any big announcement because Nvidia usually beat the earnings top and bottom in the past several quarters. And we will also identify the expected move, or you can choose a strike you are happy to sell or let it go in the case of worst case scenarios. Now, even if you don't know how to do that, that's fine. If you can't decide what strike price you need to choose, you can choose a strike price where the probability of in the money is less than 10% or preferably around 5%. In terms of delta, you can choose somewhere between 5 to 7% strike price. Now, after entering the trade, we're going to manage the trade. Typically, our cover call strategy have an edge to it. So we have 4 walls of protection. So this strategy is safe using cover calls. There is no real risk to downside movement. The only downside is this strategy limit the upside of the sudden Nvidia price appreciation. The second wall of protection, since we are trading only 7 days and avoiding earnings, we are basically avoiding any surprise movement, and we will try to optimize our stock appreciation as much as we can. The third wall of protection is we will trade outside of the expected price movement. Since expected price movement is greater than the realized price movement, by trading outside the range of expected price movement, we have a very low chance of our strike is being tested or being breached. The fourth wall of protection is we will trade the delta between 5 to 7% or probability of in the money less than 10%. Okay, so now that you know how to manage the trade and then the risk around it, let's talk about another important thing in this cover call, which is the exit strategy. The exit strategy for cover call is very simple. You can either exit at 80 to 90% of the premium collected and open up another cover call at the next weekly expiration. You can just let it expire because the touch-up probability is higher than the probability of being in the money for the stock, because usually when the stock price comes and tests the strike price, it usually retreats to the lower level. Okay, so if the strike price is about to get breached and you have a fear of this gonna get breached and go higher up, you can roll out and up if the strike price is being tested. So now I will show you how to. Okay, to roll your cover call, you just right click on your position, create rolling order, choose to sell, and then you make sure that the size of the contract that you're rolling is the same size as what you currently have, and we're going to roll out from the existing week to the next week. So the current week is December 13, 2024. We're going to roll out to December 20, 2024, which is a week out from now, and we're going to roll out and up. So when I say roll out and up, I'm saying your current price is 155. Since you got tested at this position, you want to make sure that the next strike price you choose will not be tested or will not breach, right? So in this case, we're going to choose a strike price that's higher than 155. So as high as possible. I don't like to take credit at this point anymore, so we're going to try to choose 160 strike price and see how much credit we can still collect. So 14 cents. If you want to collect this 14 cents and you don't think the price will not reach to 160, you can choose this. But in this, I'm actually going to go to 165 and see, okay, 165 is 1 cent. So I think I'm happy with this. I'm just gonna go ahead and send this order, and you will see you will not collect any credit in this case, right? So credit $10 because of 1 cent, and then minus a commissioning fee, that will leave you $3.25 credit, basically nothing. So once you're happy with it, you can go ahead and send it, and that's how you roll your cover call.